Let's go to the big story. The rate setting committee of the Central Bank of Nigeria today agreed to raise the country's headline lending rate by 50 basis points to 18.5, now keeping the hawkish stance of the financial regulator in its inflation targeting mode. Let's take a bit of the post-monetary policy committee briefing held by the Central Bank Governor, Godwin Emefiele.
The committee's decision. In the opinion of members, the key policy dilemma at this meeting was either to hold or hike the policy rate marginally to offset the moderate increase in headline inflation. Considering the option of a hold policy, the committee reiterated the empirical counterfactual evidence of a do-nothing and believe that the rate hikes have indeed helped moderate the continued rise in inflation, albeit month on month. In addition, the evidence revealed that the rate hike has also helped moderate growth in new credit and reduce the pent-up aggregate demand, which had contributed to the inflationary pressures. Members were unanimous in their conclusion that the current policy stance is indeed impacting the targeted parameters and yielding the expected outcome, albeit and somewhat slowly. Reviewing the arguments to further hike the policy rate in a bid to subdue aggregate demand, members noted that the current uptrend in inflationary pressure was driven by a combination of both demand and supply side issues. The MPC observed the continued upward risk to price development driven primarily by expectations of rising energy and food prices, unabating security challenges in food producing areas, as well as persistent exchange rate pressure. The committee thus felt it expedient to continue to address the demand side issues falling within the ambit of its policy tools. The balance of the argument thus leaned sufficiently in favor of a further hike, albeit less aggressively, considering the adverse impact of rising inflation on real income. The MPC therefore opted to tighten, though moderately, to 1. Indicate the MPC's conviction that the current policy stance is moderating the rising inflation, albeit month by month, and sustaining the stance will consolidate the gains made so far. 2. Support the efforts towards moderating the demand pool inflation as cost of funds increases and discourages further build-up in aggressive demand in the face of declining output growth. 3. Narrow the negative real effective interest rate gap and moderate the associated consequences, including discouraging domestic savings mobilization and waning investor confidence. And 4. Effectively moderate the monetary phenomenon in the current drivers of inflation by tempering both economic and financial conditions and sweep up the inflationary excess liquidity in the system. And 5. Boost the bank and the committee's credibility following its earlier forward guidance to continue to tighten when confronted with unabated rising inflation. Members thus resolved by unanimous vote to raise the MPR, but moderately. 10 members voted to raise the MPR by 50 basis points and 1 member by 25 basis points. All members voted to keep all parameters constant. In summary, the MPC voted 1. Raise the MPR to 18.5%, 2. Retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR, and 3. Retain the CRR at 32.5%, and 4. Retain the liquidity ratio at 30%.
Well, in the meantime, Nigeria's economic growth, or GDP, in the first quarter of January to March came in at 2.31%. That's lower than the stronger 3.52% recorded in the final quarter of last year. Joining me live now to drill into these latest monetary and macro developments is Steve Osho, is a market professional and a co-managing partner at Commercio Partners. Thanks for coming in at this time. Thank you so much. We appreciate it.
Thank you.
Great. So you've just listened to the considerations and the decisions. It looks like not just the governor talking about the decisions, but of course the road leading to this particular rate decision. What do you make of those 5 points the governor outlined?
I think from what the governor said today, most of the decision they actually made today was actually anticipated. Anticipated in the sense that if you look at the way and the manners actually the members voted, one member voted for 25 basis point hike, and the rest, the 10 members actually voted for 50 basis point hike. So which means that in unison, actually they agreed that there must be a hike. Is the level or the percentage of hiking that actually was the discussion point at the meeting. So for me, I think it was anticipated. If you look at what has happened for the past few years when we have the inflation at the highest point since the highest level since 2005. So I think it would demand some level of response from the regulators, and that's what they've done. And if you look at where they've anchored the points on, they've talked about, the dicey situation we have right now on the back of discussions of US on the roofs, on the debt ceiling.
Yes, on the debt ceiling, yes.
Then you have the issues around the Ukraine-Russian war, which is still going on right now. And you have that, issues around the policies around the government.
Whether even the US Fed will still raise rates by June.
Well, it's likely.
It's still it's a card on the table.
Yeah, but it's card on the table. And if you see the way all the Fed across the world has actually responded, you've seen that, the contractual response has actually been
Is inflation targeting a lost game for us on this side of the Atlantic?
I don't think so. And I think the governor actually alluded to that because a lot of people actually worry that, okay, we'll keep, increasing rate and we have not seen that response. And what is responding is that, this thing takes time. So there's a lag effect, which will eventually kick in. And the option you have is either you do this or you leave it open, which actually could make it worse. So what he's saying is that over time, if you had left it undone or approached or, unresolved, the possibility is there that you're going to see maybe inflation around 30%, which is close to what you have in Ghana and in Turkey. So I think it's a right step in the right direction. I will need to wait to see what the effect will be in the long run over a period of time.
But coming
and
from
when we talk about,
you
talk about the cost push inflation,
yes,
it takes time to actually have that lagging effect to actually kick in your monetary policy response.
Again, so we look at the first quarter GDP numbers that just came in today. Well, what's your take when you look at 2.31% in the first quarter than below 3.52% in last quarter?
I think the GDP number is the reflection of what we've gone through for the past few months. I think the first quarter...
Since the start of the year?
Yes, since the start of the year. I think the first quarter this year was actually very turbulent in the financial space and the macroeconomic space. So the results that we are seeing from the GDP numbers actually indicate that. Despite the fact that we've seen an increase in production in oil from an average of about 1.3 to 1.4 last year, quarter on quarter, to about 1.5 this first quarter in 2023.
Yes.
Yeah, but if you look at other basket that contributes to that GDP, the non-oil sector is actually slowing down. And, you could attribute that to the Naira redesigning that we had, first quarter, the scarcity of the currency that we have, low output, and all the inflationary pressure that actually, affected the manufacturing and all of that.
Even agriculture.
Yes, even agriculture.
Yes.
Agriculture, you understand that, during the Naira redesign, most of the farmers were forced to sell their product at a discount rate, because a lot of people could not generate Naira to be able to buy their produce. And you could see that response or that implication was seen more on the informal sector than the formal sector. If you look at telecom moved up a bit compared to what we had in the last quarter of 2022 to first quarter of 2023, because a lot of people have moved from, there's a lot of patronage on the telecoms. And if you look at the banking sector, look at the insurance services and finance, there is a bit uptick in that area too in contribution to the GDP because, if you look at the movement of people into a digital payment system is actually increased rather than just carrying cash up and down. So I think a lot of that actually fed through into what we have in that effect. But if you look at agriculture, You look at transportation, construction, manufacturing. That's actually slowed down.
Yeah. So what does this leave us as far as the GDP, the MPC is concerned? Do you see a deceleration in rates anytime soon by the MPC for later in the year?
I think considering that this is the last MPC that's going to be held under the Buhari administration before we go to the next deposition of the...
The next MPC will be in July.
Exactly. So I think it's the right decision to take. I think some of this effect, like we said, will have a lag effect, which will kick in maybe towards the end of the year or maybe by third quarter of this year. But I think a lot of things still depends on what the policy of the new or incoming government would be. From what I'm hearing or what I'm seeing, the government will still need to spend money and the government will still need to borrow. So which means that as long as you're spending money, you are increasing the amount of money in circulation, you're still putting pressure on inflation, and the monetary policy authority will have to respond to that by doing one thing or the other.
Interesting time we were. I'm just trying to find out what your you have inflation running almost neck to neck now with the NPR, 18.5, 22.2. The gap keeps contracting, narrowing. So, what does all this mean for financial assets, investors, and all that on Market Street?
One of the reasons why they didn't want to actually slow down on the NPR increase was the fact that if you look at where the yield curve is right now from the government bonds and T-bills, there's a real negative return, compared to where the inflation number is. Inflation is the upper end of 21. We have the yield of government papers, 20-year, 30-year bond trading around
13, 14,
15, 16%.
Yes.
And we have T-bill trading, single digit. So I think what that will mean is that you are not going to see more FPI coming to the system, and at the same time, the local investors will actually have negative returns. So we need to look at that as it affects, growing money and in the capital. But at the same time, we have to look at what is the implication on stifling growth, especially for the manufacturing sector. So it's a delicate balance that you have to look at here and there. But at the same time, we have the time to be able to see how the effect of this hike in NPR will look at, and at the same time see how much we can use to actually accelerate the real sector.
But do you think the second quarter GDP will come in a little bit better than first quarter, April, May, June?
I think
based on the fact that we're done with the elections, the Naira redesign thing is all moved till December according to the Supreme Court. And
I think that's the good point you've actually made there, because if you look at the Naira design issues that we have, it looks like we're behind it now. And if you look at the other issues associated with that, I think some of them will actually slow down a bit. So I see more of accelerated growth in GDP from this present number of 2.3 to maybe something closer to 3% in the second quarter. But I don't think we're still going to move as close to what we had in last 2022.
For Q4?
Q4,
3.52%. Exactly. But you think you could still ramp up to 3.5% by the end of this year? I think
by the end of the day, by the end of the year, if we have the policies of the incoming government actually smooth up, and we have activities actually take shape in the manufacturing and other real part of the economy, I think we're going to see some level of growth. Whether we're going to get to 3.5 and above, I'm not too sure of that, but I think there's going to see some increase between now and the end of the year.
It's going to be a little bit tough how it is. So I'm just trying to look at your prognosis for the second half of the year when the second administration is fully in place.
Well, I think the financial market has reacted so far. If you notice, on the yield curve, it's been relatively flat. We've not seen so much of movement there because people are anticipating that this government is still going to borrow, when they come to power. The level of borrowing, we don't know yet. I think some of those plans and programs will become more and more obvious by the time the incoming president actually run out his plan and program for the next 4 years. And looking at how much of this budget for 2023 have been spent and how much do we still need to actually borrow in terms of the shortfall we had in the budget. I think that would determine quite a lot of things that will happen The equity markets has been doing well so far, even though there's just barely about 3.5% year to date performance. But I think globally, the global economy is actually on a very slow pace. Nigeria is actually not exempted from that. So I think that is what will determine what's going to happen between now and the end of the year.
What are you folks at the top C-suite hearing these days from the investment market, from investors, both local and abroad? What are they talking about, thinking about this major transition in governance and leadership around the near to medium term?
I think there's one side from the investors' point of view and the other side from the people like us who are market operators who are talking to these investors. But I think all of us seem to be in sync in terms of cautious approach to investment between now and the end of the year. The reason is because we're coming from a very bad season globally. And if you look at how some of the Eurobond in sub-Saharan Africa has performed and what you've seen on the yield curve in Nigeria and the rest of the world, I think a lot of people are actually being careful now to see how some of these things will pan out. Equity markets has actually been another thing people are putting eyes on. But again, in terms of basket of investment and the rising for appetite for risk, a lot of people have been cautious, both from the investor's point of view and the market operator's point of view.
Okay. So, but you think perhaps we'll be able to still finish the year on a positive note, depending on a number of factors? I
think we're positive. We're positive because we believe that the incoming administration is someone that understands the market. And considering the legions of all the problems that they have right now, I think they need to put on their thinking cap to solve some of this problem. And we're quite positive that if we are able to check on insecurity and be able to get the monetary policy decisions and policies right, and at the same time be able to harmonize between fiscal and monetary policy authorities, I think things will actually take shape and will be positive. I'm positive.
I know. Oh, I love that. Okay, I'm going to take that positive and put it in a pocket for tonight. Thank you so much. It's good having you here.